look at your pipeline and start planning on 2025. Make your goals now, whether you're passive, whether you're active. Know and write down your goals for 2025.
Welcome to the Best Ever CRE show, the world's longest running daily commercial real estate podcast. If you want real stories behind the good, the bad, and the worst ever deals, plus insights into what really goes on in the commercial real estate investing, you're in the right place. Our hosts interview commercial real estate experts every day to uncover secrets and strategies you can use to become a better, more informed investor. This is the Best Ever CRE show.
Best ever listeners, welcome to the Best Ever CRE Podcast. I'm your host, Joe Cornwell, and today I'm joined by Karl Krauskopf. He is a founder of Gold Multifamily. They are value-add multifamily syndicators. He has over 85 units based in Seattle, Washington. It's Karl's first time on the show, so Karl, welcome, and thank you for joining us.
I appreciate it, and I'm excited to be here. Thanks for having me, Joe.
So let's start with your background. Where are you from, and how did you get into real estate?
So I am originally from East Coast of Florida, grew up surfing there, and now living in Seattle, Washington. So as far as family as possible in the contiguous U.S., how I got into the real estate space is really just looking for additional income. About 7 years ago, I was working a corporate strategy, a chief of staff role, a business services group down in Los Angeles, and just didn't have enough income. My wife and I were having a conversation about having a kid, and wanted to have a little bit more control over our future and essentially our dollar. And so we started looking at ways to increase income. It was day trading, stock trading, etc. Didn't work out for us, and started buying some small multifamily. And long story short, now we're 85 units under management.
Okay, very cool. Take me back. So you're from Florida. What brought you to the West Coast in the first place?
Good question. So we had a short layover in Dallas, I call it, 4-year layover. And that was essentially a job, right? Work moved us from South Florida to Dallas. And I was working there for about 4 years. Still same company. Ended up moving out to Seattle simply for the love of the mountains. We're big, avid outdoors people. We love hiking. I'm an ultra marathon runner up here as well. So just as much time outdoors as possible.
Okay. So that's interesting. I don't know a lot about Seattle. Went there once as a little kid, but when I think of Seattle, you hear always the raining complaints. It rains, however many hundreds days a year. So I guess you're used to being outside in the rain. Is that the idea there?
Absolutely, man. We're waterproof, as some of the sayings that we get. There's no bad weather, just bad clothes, some other sayings there. But no, it's just something that you live with and you deal with. It's no big deal. It's mostly just mist for the most part. The gray and cloudy is probably the biggest challenge most people have. And we just figure out how to work around that.
Gotcha. Yeah. See, I'm from the Midwest, live in the Midwest still. And yeah, our ideology is if it's bad weather, we just don't go outside. So we're shut in for about 4 months out of the year. All right, cool. So got into real estate just by wanting to create an additional income stream, still working in corporate world. Are you full-time in real estate now, or you still have a W-2?
Full-time now. I've been 3.5 years.
Okay, very good. So take me through that journey. So it sounds like you started with a couple smaller deals. At what point did you start scaling up into some larger properties?
I started scaling with development. So even backing up a little bit from there, we bought our first duplex exactly 6 years ago to the month. And it was great. Loved it. Loved the rental income that we were getting from it. Bought a couple more small multifamilies, duplexes and triplexes. Same area, which was Eastern Washington at the time. And we're quickly running out of money. We didn't have a way to effectively execute the BRRRR strategy. We didn't have a way to refinance our cash back out of those, simply because, again, we were new into the space. Yes, read 6 months worth of books and podcasts, but nothing really prepares you for the real world until you actually start. So that's where we were at, is running out of money, had enough money for one last deal, essentially. I thought, hey, this is a great time to flip a home. Also had a daughter at the exact same time. Daughter was born in January, bought a hoarder home in March. Not great timing, by the way. And did incredibly well in that first flip. This is back in 2019. Money was easy. Contractors were out everywhere, so it was easy to find work. Cost of construction was low. So just about anything you could effectively manage, you could make some decent money on at the time. Turned that flip into 3 new flips, and then just continued to scale, I would say, relatively slowly. The first year was 4 flips. The second year was another 4 flips. And then the third year started moving into the larger scale stuff. So building townhome developments, built 13 townhomes that third year when I transitioned out of my corporate job into real estate full time. is when I started developing.
Okay, so these were build to sell townhomes. Because that was my first thought. You hear the headlines, let's say, of Northwest. Everything's super expensive. It's really hard to get anything done. A lot of red tape, a lot of costs. Do you think that is a true summary of that, or do you think that's overblown?
No, boots on the ground, absolutely, it is true. It's difficult to get things permitted from a townhome perspective, right, where you're not pushing the envelope, you're not pushing anything from a development perspective. You're literally just build to your right that you can based on zoning. That's going to take you anywhere from 9 to 12 months just to get through the permitting phase. And then you got another 12 to 15 months on the development side. So development has a ton of risk associated with it simply because of the long tail of when you start the project to when you actually liquidate it can be as much as 2.5 months depending on the complexity of it.
Okay. So let's break down that deal. So how did you find it and what did you buy? I guess the land or whatever you tore down there.
Good question. I thought the best way to start into that space of development was actually buying entitled land. So I didn't have to go through the full 24-month process. I bought and closed with a shovel-ready deal, which made things much more advantageous for me on the exit. This is now, must have been 2021 when we were buying the development land, entitled developments. And it was going well. We exited most of those deals very, very positively in the spring and summer of 2022. And that is really all that I ended up doing on the larger scale development, maybe a mid-size scale on the townhome development, and phased out of that and into the larger apartment complexes shortly thereafter.
Okay, so on that development, what was your average all-in cost per unit and what were you selling this for?
Good question. So average all-in cost, let me think about that for a second. I know our per square foot basis was anywhere from $285 to $295 a square foot. So I think our all-in cost on the actual land plus development costs must have been around $450,000. These are 1,200 plus or minus square foot townhomes, and we were selling them for high sixes, low sevens.
Okay, got it. And was that a deal? Were you funding that yourself? Were you raising capital from outside investors?
Good question. So that was the start of the formal syndication space, and raised it from traditional friends and family, father, uncles, et cetera, et cetera.
Okay, so syndication model, raised money from people you knew.
Yep.
So it sounds like you had a good margin there, right? It's 200 plus thousand per door. And how many of those did you build?
13.
Okay, so just rough math, 2.6 million plus in revenue.
Yep.
Very good. And I think you threw out 295 was your basis per foot on the build. Now that accounted for the shovel ready land you purchased and construction costs.
Correct.
Yeah, that's not bad. You said this was what, 21 you started this
2021.
project?
Yep.
Yeah, man, that's definitely less than I would have thought.
The lumber was the big savings. We essentially bought our lumber pre-major spike in the commodity expense. So one of the deals we did, second deal we did not. Unfortunately, the second deal was essentially bought at the spike. So we had not the best timing on that one, but that ended up turning out positive still.
What was your price per foot on that, just for contrast?
About $310 a square foot. And not only was the lumber, the timber itself more expensive, but we also had a fourth floor to add to those townhomes as well. So the actual dollar per unit as well as the volume of units was higher on that latter build.
Gotcha. Did you have a similar proportional upside on the sale, or was it compressed?
Yeah, it was obviously a bit more compressed, not only from the construction cost perspective, but also timing of the market. I mentioned spring and summer of 2022. If you remember what happened in late summer of 22 was the 75 BIP increase on the Fed rates. Buyers dried up, and essentially we couldn't find a buyer for a portion of these townhomes. And so we ended up refinancing those. Luckily enough, we had plenty of equity in the property to be able to do that. We get out of our short-term construction debt and get some long-term fixed rate debt on those projects. So it didn't go according to plan, didn't go to plan A, but luckily we had a solid plan B in place and a takeout lender who was prepped and ready for us from the get-go.
Okay, and so you kept those as rentals?
Yes.
Got it. You still have those today?
Yes.
Got it. Is there a plan at any point to sell? I assume these are individually parceled, right? So you
Correct.
can sell these off. Do you have plans to sell them, or do you plan on keeping them?
Definitely selling them. And luckily, again, like I mentioned, we have 30-year debt on them, traditional financing on each one of them. So we don't have to do any kind of partial release or anything when we do decide to sell. However, it's, I would say, a game of inventory, right? What's available on the market right now versus where do we think buyers are going to be. So it's either April 2025 is when we would be looking to sell, or potentially 2026. Timing the market is a little bit difficult. From my perspective, I think we're going to be taking it to market on the 2025 space. So that way we can get capital back out and reinvest.
Makes sense. Okay. And then you said you raised money for that deal also as well. Okay. So when you look at your market, and it sounds like you're obviously some different submarkets in Washington, but looking at Washington or the Northwest in general, how are the inventory trends with the supply and demand working today?
Great question. So we just had our big spike wrap up earlier this year in terms of incoming inventory, specifically Seattle. Seattle being the primary market that we're in. The other markets, Wenatchee, which is a central Washington market, and then Spokane, which is eastern Washington. Spokane is right about to hit their spike of inventory. Wenatchee's long done with their spike of inventory, and Seattle just hit their spike of inventory in the summer. So now we start seeing this inventory kind of peter along in a downward trajectory until the first quarter of 2025. And then beginning second quarter of 2025 is when things fall off dramatically, right? We're talking like 60% reduced volume year over year in terms of new inventory, which obviously we expect that's going to positively impact rents and vacancy, reduce concessions and things of that nature. There's, I would say, a double tailwind for the 2025 year is not only that from an inventory standpoint, but also demand. Amazon return to work 5-day mandate just get announced within the last month. And from, again, boots on the ground, talking to the Amazonians, who are many of our clients, is that they are going back to the office. There was a thing called a coffee badge. That was the term that they used, coffee badge, which was you badge in, you get your coffee, and you leave. And you go back to working from home, which was happening. The management was counting that. However, now it's dramatically different. Now it's not only counting the times that you do badge in and out, but it's the amount of time that you're in. So from a corporate standpoint, Amazon and some of these other big headquartered employers here are really keeping a tight eye on the actual return to work. So I think we're going to see 2 tailwinds in 2025, which is going to really help on the valuation in the multifamily space here.
That was my next question. What sector of the real estate inventory market do you think that's going to benefit the most? But it sounds like your answer to that would be multifamily. I'm assuming in the metro areas.
Yeah, anywhere within probably a 5-mile radius of core Seattle. Core Redmond would be the other one. For Microsoft's headquarter is going to see dramatic positive impact on valuations.
Okay. I don't know a lot about the Northwest markets. That's why I'm asking so many questions. But did you see that mass exodus of the town centers, the metro centers during COVID, where people were buying and moving into the suburbs of these major metros? Did you see that trend like a lot of major areas?
Yeah, absolutely. So we started seeing the skirts of the secondary market start to become saturated and overdeveloped pretty quickly. We had developers building these massive build-to-rent communities, let's call it 45 to 65 minutes outside of the core. And those are your typical cattle homes, master plan development sites. And those started coming up in about 2022, about 2 years after COVID. And when people had the mentality of remote work is here forever, hybrid work is here forever. And I still think there's definitely been some positive things from the hybrid work model. And I think a lot of people are going to stay in that model. But some of the big employers who have a ton of leased office space in these core office spaces, they're bringing people back.
Yeah, that's just paying attention to social media and a lot of the corporate threads on like Reddit and some of these other forums. You see this ideology from the masses of where, at least the perspective of it sounds like these employees, is that they are trying to force in-office work again to save commercial real estate. What are your thoughts on that sentiment?
It's a good question. I don't know if it's necessarily the actual CEO of these companies that are saying, I want to save commercial real estate, for example, but I would say the partnership that they have, Andy Jassy and some of the others, they're looking at it as a partnership with the cities that they're operating in and almost like a goodwill, if you will, right? So 2 years ago, we had the corporate head tax that impacted the city of Seattle.
Tell us about that.
Essentially, employers that make over a certain revenue, they are taxed at a higher rate. And I'm not obviously an expert in this, but they're taxed at a disproportionately higher rate if their employees are making above $150,000, for example. So essentially, if you're operating within the city, is that employer's taxes are going to be disproportionately higher now all of a sudden. And so that certainly did move quite a bit of the Amazon employees from Seattle itself to our sister city, Bellevue, which is just on the other side of Lake Washington. We call it the east side. And Bellevue is seen as more of the capitalistic friendly. They're not doing any kind of head tax or any additional taxes like that. So they're much more business friendly and have been attracting significant growth in the office space in Bellevue.
All right, shifting gears a little bit. Do you have a deal in mind that you want to share with us, whatever type of deal you want to talk about, that did go to plan, did hit your business plan or exceed them?
Yeah, absolutely. So we are, I would say, close to 85% complete with this business plan, but I would say from a financial perspective, ahead of schedule. So the example would be a large townhome community that we ended up buying, 33 units in a city called Wenatchee, as I mentioned, Central Washington. Backing up before I talk about the deal itself, Wenatchee is a hub and spoke where you've got these other really luxury high-end short-term rental markets, Leavenworth, Chelan, as the spokes, meaning they are the ones that are leveraging the infrastructure that the city of Wenatchee has. You've got other working class cities like Ellensburg, Quincy, et cetera, that are all focused on the infrastructure that Wenatchee supplies. So Wenatchee is about 125,000 population, so not dramatically big, but it supports all of these tertiary markets. And again, great place. Anyway, we bought a 33 unit townhome project there. And the idea with that project was the rents were about 60% below market. It was poorly managed, had a ton of operational inefficiencies. One example would be the 33 unit townhome had a $45,000 on-site manager, but was also paying a 5.5% third-party management service. And so there was a lot of duplicative expenses that the past seller was paying. We had a couple other line items from an expense standpoint that we knew that we could go in and shave pretty quickly. Insurance, they were paying something 3x what we were quoted initially. So again, great areas that we were able to go in and do some immediate expense reductions. Went in, the idea with this project was every single unit needed a remodel. Baseline cosmetics, upgrading Formica original 1977. I should have mentioned that up front, 1977. Cabinetry, a lot of them had original carpets, which is surprising, but overall good bones, good structure. So cosmetics, which is a great upgrade. The secondary, which was more lucrative, was these townhomes had unfinished basements, daylight basements. So these are basements that already had either egress doors, egress windows, they just were unfinished. So our plan was to go in, add 1 to 2 bedrooms plus a bathroom in these unfinished spaces, converting them from a 2-bed, 1.5 bath to either a 3-bed with an office or a 4-bed with 2.25 bathrooms. So really, really upgrading the tenancy, as well as obviously the rent associated with what we would be getting for a per unit basis. Over the course of about 6 months, we renovated a little over 50% of the units. Continuing on, once we finish, again, I mentioned 85% done, we'll have increased the net operating income by 170%. So taking it from 257 when we bought it, and we'll be at, want to make sure I get this number right, should be just on the low end of 600,000 from a net operating income perspective. A lot of that is rent. We're taking average rents from 1,200 up to 2,000, with the major reason being that we're increasing the 2 beds into 3 and 4 bedrooms.
Yeah, that was my next question, was your average rent, but I'm very surprised to hear that again, most of what I hear about the Northwest is just headlines, but I would have thought your rent basis was a lot higher. It sounds like, though, this isn't necessarily the major, really expensive downtown metro.
Right.
So obviously, if you transplanted this into Seattle area, it'd probably be significantly more expensive.
Right. Our 2-bed, 1.5 bath, true, just a townhome style, 1,200 square foot. We're getting $1,949 for a fully renovated product out there in Wenatchee. If you were to transplant that same townhome over here, you're probably going to get high 2,000s, 2,800 to 3,200.
Okay. So it's about 50% higher or something like that.
But Cost basis is radically different. Cost basis in Wenatchee, $190,000 per unit, whereas you buy that same unit here in Seattle, you're probably talking high 500,000s at minimum.
Wow. Okay. Yeah. Your rent ratios are a lot stronger in that central market.
Yep.
Okay.
Yep.
So what was your entry and what will your back end value be on this property?
Entry 6.4, back end 11.5.
Great. Okay. So almost doubling your equity there.
Yep.
And what is your plan with those?
Good question. So 3 separate exit plans. Exit plan 1, sell as is to a single buyer. That's the easiest, cleanest. We can 1031 exchange that into something obviously much bigger. The original business plan is actually to condominiumize and convert these townhomes into individual condos, selling them 33 units a piece and really at a premium. A residential space is going to pay quite a bit more on a per unit basis.
What do you think that spread is?
The delta is probably about 20%, right? We're talking about the difference between maybe 410 and 350. 410 on a premium per unit basis, whereas the single asset would be 350.
Okay. What do you think your associated costs would be with parceling those out, HOA, whatever else you have to do?
I would say minimal, maybe 50,000. I've done the condo conversions probably half a dozen times, primarily in Seattle, in Wenatchee as well. Cost associated with it and timing is pretty minimal. Probably 3 months. If I'm lazy, 6 months. Cost associated, like I said, 50,000.
Okay. And you've been investing since 2018, you said. How would you say your philosophy, your strategy has changed over that time?
Yeah, it's come full circle. Originally, small multifamily was doing this for rental revenue, then flipped into build or renovate to sell. I transitioned back to the long-term holds back in 2021, October, and essentially Fed Powell, Janet Yellen saying inflation was no longer transitory. A new monetary policy was going to change at some point. I stopped buying. I educated myself and started buying larger multifamily with the intent to hold long-term fixed rate debt back in 2022. That's where we're focused. That's where we're at now, value add. Also incorporating some turnkey core products. So that way we've got a variety of offering to our partners where we've got the 3 to 5 year exit, introducing construction risk into that. Whereas the flip side would be, long-term 5 to 7 years, no or little construction risk with buying newer vintage products.
Got it. And it sounds like your goal on the exit for some of these deals you've had in progress is to sell these and then recapitalize that 1031 into maybe multifamily longer term holds.
Just depends. I don't know that it would necessarily be into the long-term holds again. Assuming the Eastmont property, the 33 unit, right? The majority of those investors are all in the hyper growth phase of their lives, of their investment. So they would more likely be apt to 1031 into another value add project as opposed to 1031ing into a turnkey core product.
It makes a lot of sense. Okay, what is one piece of actionable advice you can give the best ever listeners for ending Q4 2024 strong?
Good question. Look at your pipeline and start planning on 2025. Make your goals now, whether you're passive, whether you're active. Know and write down your goals for 2025 well before you get to 2025, because 2025 starts January 1st, not March 1st. So
yeah, no, it's good advice.
Get in there, get your goals down.
It's great advice. I need to work on my goals and get them ready for next year as well. All right. Where can our best ever listeners connect with you and find out more about your business?
Awesome. 2 places, gold-mf.com and LinkedIn is the other place. I love LinkedIn. It's a great place for us to share not only our content that we post on our website, but also daily content from life lessons. Like I mentioned, I'm an endurance runner, so a lot of the corollaries I draw between running, mountaineering, and business.
Very cool. We'll be sure to link to that in our show notes. Thank you so much for joining us today and sharing all your experiences.
My pleasure. Thanks, Joe.